When people think about market crashes, they imagine chaos. Headlines filled with fear, traders yelling into phones, stock tickers bleeding red, and families watching decades of savings evaporate in a single week. They picture 1929, men in suits on Wall Street, faces pale, pockets empty. They remember 2008, neighborhoods lined with foreclosure signs, dreams crushed under the weight of debt. To most, a crash is the end of prosperity, the ultimate symbol of failure. But what if that story is incomplete? What if every market crash isn't just destruction, but transfer? A quiet reshuffling of wealth from the emotional to the rational, from those who panic to those who plan. Because history shows a truth few ever talk about. Every major financial collapse has birthed a new class of millionaires. Let's rewind. After the crash of 1929, America plunged into the Great Depression. Unemployment soared, banks failed, and the Dow Jones lost nearly 90% of its value. Yet the people who stepped in while the streets ran red, the Rockefellers, the Mellons, the Morgans, came out owning America. They bought railroads, oil fields, and manufacturing giants for pennies. Within a decade, their wealth didn't just recover, it multiplied beyond imagination. Fast forward to the year 2000. The dot-com bubble bursts. The Nasdaq loses 78% of its value, wiping out trillions in paper wealth. The headlines declared the death of the internet economy. But for those who understood value, it was the beginning of something extraordinary. Amazon fell from $107 to $6. Netflix traded for less than a cup of coffee. Apple, Google, and Nvidia were all dead stocks, according to Wall Street. Yet the few investors who saw past the panic made fortunes that redefined wealth in the 21st century. Then came 2008, the great financial crisis. The system cracked under the weight of its own greed. Housing collapsed, banks imploded, and fear swept through every market. But look closer. Those who had cash and courage stepped into the ashes. They bought foreclosed homes, invested in distressed companies, and accumulated assets no one else dared touch. When the dust settled, the next bull market began, the longest and most profitable in U.S. history. Each time, the pattern repeated like clockwork. Panic, collapse, recovery, prosperity. And those who prepared didn't just survive, they ascended. That's the rhythm of capitalism: destruction, renewal, and rebirth. Every crash is a cleansing fire that burns away illusions and exposes what's real. Now we stand at the edge of another precipice. The signs are everywhere, flashing red across every major economic metric. Inflation refuses to die. Corporate and government debt have exploded to levels that defy logic. Stock prices are soaring on borrowed optimism, not real earnings. The housing market has become a ticking bomb, inflated by years of cheap money and speculative frenzy. And behind the scenes, global supply chains remain fragile, energy costs volatile, and geopolitical tensions simmering between the world's biggest economies. What's coming in 2026 won't be another soft landing. It's shaping up to be a complete reset, a fundamental rewriting of how money, markets, and power interact. This isn't fear-mongering, it's mathematics. Every empire, every financial system follows the same cycle of excess and reckoning. When debt grows faster than production, when speculation replaces value, and when policymakers try to defy gravity by printing money, collapse becomes inevitable. The U.S. economy has followed this rhythm for more than a century, a roughly 18 to 20-year cycle of boom, bust, and renewal. We saw it in the roaring 1920s and the depression that followed. Again in the 1970s, when stagflation crushed the post-war boom. Again in the 2000s, when easy credit fueled the housing bubble and led to the crash of 2008. Each time, the system pushed itself to the brink, reset violently, and rebuilt stronger for those who knew how to adapt. And now, the clock is ticking again. Look at the numbers. The Shiller-Cape ratio, a key measure of how expensive stocks are compared to actual earnings, is at its second highest level in history. The only time it was higher? Right before the dot-com crash that erased trillions. Corporate debt has ballooned to historic highs, much of it borrowed at near-zero interest rates that no longer exist. As rates rise, that same debt becomes toxic. Consumer debt is breaking records too. Credit cards, auto loans, personal lines of credit, all rising at double-digit rates while savings dwindle. Americans aren't spending from strength. They're spending from desperation. Every purchase is borrowed from the future, and then there's the government. The U.S. national debt has crossed 35 trillion. Interest payments alone are becoming one of the largest line items in the federal budget, rivaling defense spending. The Federal Reserve is trapped. If it cuts rates, inflation returns. If it keeps them high, debt service becomes unsustainable. Either way, the foundation cracks. Meanwhile, the rest of the world isn't faring better. China's property sector is collapsing under 9 trillion in hidden liabilities. Europe is grappling with an energy crisis and slowing growth. Emerging markets are drowning in dollar-denominated debt. The entire global system, interconnected by trade, finance, and digital networks, is stretched to its breaking point. This isn't random chaos. It's the natural consequence of decades of artificial prosperity, a world addicted to cheap credit and constant growth. The crash of 2026 will be the hangover from a global financial party that's lasted far too long. But here's the paradox. The end of one era always marks the beginning of another. The 2026 crash won't destroy wealth. It will transfer it. It will move from those who spent recklessly to those who saved strategically, from those who chased hype to those who studied history, from the fearful majority to the prepared minority. Because in every crash, value doesn't disappear. It changes hands. When markets fall 50%, 60%, even 80%, they don't wipe out real assets. The factories still exist, the land still produces crops, the technology still functions. What changes is ownership. Those who panic sell their shares to those who understand what they're buying. That's the real wealth transfer. And make no mistake, the setup for 2026 is nearly perfect. The speculative excess is back. Meme stocks, crypto bubbles, AI hype, and unsustainable valuations are all symptoms of the same disease. Belief that the good times can last forever. But the market doesn't care about belief. It only obeys mathematics and cycles. Soon, the illusion will shatter, just as it did in 1929, 2000, and 2008. And when it does, those who have studied the pattern will be ready. The question is not whether the crash is coming. It's whether you will be on the right side of it. Because while the masses panic, history's next generation of millionaires will quietly be taking their positions. Every great financial collapse begins with the same illusion: stability. The months before the fall are calm, the headlines are optimistic, and experts repeat the same comforting words. This time is different. But history laughs at that phrase. Because every time investors believe they've outsmarted the cycle, the same invisible forces start moving beneath the surface, slowly tightening the noose. Today, we're living in that calm. The markets are high, unemployment is low, and politicians are celebrating record stock prices as proof that everything is fine. But dig deeper, and the cracks are already spreading. Start with corporate debt, the silent killer of bull markets. During the pandemic, companies borrowed trillions at near zero interest rates to survive or buy back their own stock. Now those loans are maturing, and they must be refinanced at triple the cost. Imagine a business that borrowed $1 billion at 2%. Suddenly, that same debt costs 7%, an extra $50 million a year in interest alone. Multiply that across thousands of corporations, and you can feel the pressure building like steam inside a sealed chamber. Then comes consumer debt, the heartbeat of the American economy. For decades, growth has depended on people spending money they don't have. But credit card balances are now above $1.3 trillion, an all-time high, while delinquency rates are climbing faster than at any point since 2008. People are maxed out, and the soft landing narrative is masking the fact that millions are one missed paycheck away from default. Inflation hasn't vanished either. It's hiding. Yes, official numbers have cooled from their 2022 peaks, but anyone buying groceries or paying rent knows the truth. Prices haven't gone down. They've stopped going up as fast. That's not relief. That's stagnation. It means the dollar is permanently weaker, purchasing power permanently lower. The average American family now spends $1,000 more per month than in 2019 just to maintain the same lifestyle. The Federal Reserve knows this, but it's trapped. If it cuts interest rates to stimulate the economy, inflation will roar back. If it keeps rates high, businesses and consumers will break under the debt load. The central bank is walking a tightrope in hurricane winds, and history says it never ends well. This is what makes the period before a crash so deceptive. Everything looks normal, even healthy. The stock market keeps rising, fueled by speculation and algorithmic optimism. The media praises the resilience of the economy. But beneath the headlines, liquidity is drying up, defaults are creeping higher, and insiders, the people who actually move markets, are quietly exiting. Just look at the insider selling data from late 2025. Corporate executives, CEOs, CFOs, board members have sold more of their own stock than in any year since 2007. Meanwhile, small investors are flooding into the market, convinced they're catching the next tech boom. That's the psychological flip that always marks the top. When professionals sell dreams and the public buys them. Geopolitically, the calm is even more fragile. The world's economic order, built on cheap global trade, is fracturing. The US and China are no longer just competitors. They're strategic adversaries. Each is building its own parallel supply chains, currencies, and alliances. What began as a tariff dispute in 2018 has evolved into a full-blown economic Cold War. The ripple effects are massive. Corporations once dependent on Chinese manufacturing are now reshoring or relocating to Southeast Asia, raising costs and disrupting supply networks. Meanwhile, China's internal economy is cracking. Property developers defaulting, local governments drowning in debt, and youth unemployment soaring past 20%. If China stumbles, global demand collapses with it. Europe isn't faring better. Germany's industrial sector, the engine of the continent, is struggling under high energy prices and weak exports. The EU's debt levels are ballooning, and political unrest is growing in nations like France, Italy, and the Netherlands. The so-called United Europe looks less united by the day, and then there's energy, the lifeblood of every economy. The world is transitioning toward renewables, but the process is chaotic. Oil supply remains constrained, natural gas prices fluctuate wildly, and green energy infrastructure is still too underdeveloped to shoulder the burden. This volatility doesn't just affect gas stations. It ripples through agriculture, transportation, and manufacturing. In short, the foundations of the global economy are shaking. But markets, blinded by short-term optimism, don't see it. They never do. It's like 1928 all over again, the year before the Great Depression. Back then, everyone was celebrating a new era of prosperity. The Federal Reserve had just stabilized markets after a small panic. Unemployment was low, corporate profits were rising, and ordinary Americans were buying stocks with borrowed money. Newspapers called it the permanent boom. 1 year later, that illusion shattered. Or think about 2007. Home prices were skyrocketing. Credit was easy. And financial institutions were inventing new ways to profit from risk. Wall Street sold the dream of infinite growth. Then one small domino, the subprime mortgage market, fell, and the entire system came crashing down. The patterns are identical. In every case, optimism peaks right before reality strikes. And we're there again. Artificial intelligence stocks are soaring to bubble levels unseen since the dot-com era. Crypto markets, once left for dead, are surging again on pure speculation. Retail investors are gambling with leverage, believing they can outsmart the system. And major financial institutions, desperate for returns, are quietly taking on hidden risks, just like they did before every crisis in history. That's the calm before the storm, the part where the sky looks clear but the air feels heavy. The winds are still, but the temperature shifts just enough for those paying attention to sense what's coming. When the 2026 crash begins, it won't start with an explosion. It will start with a whisper, a small liquidity issue at a major fund, a missed bond payment, or a sudden downgrade of a corporate giant. Something that seems isolated at first. Then, like dry grass catching fire, panic will spread through the financial system. Investors will rush to sell, liquidity will vanish, and automated trading algorithms will accelerate the collapse. The headlines will turn overnight, from new market highs to historic plunge. Central banks will scramble to calm markets. But their tools, interest rates, quantitative easing, stimulus packages, will be blunt against the speed of modern panic. And here's the irony. This very chaos will create the greatest wealth transfer in modern history. Because while 90% of investors react emotionally, the remaining 10%, those who studied the past, understood the cycles, and prepared, will be ready to strike. They'll have cash, patience, and courage, while others have confusion, debt, and fear. That's why this calm matters. It's not peace, it's opportunity disguised as normalcy. The silence before the storm is when fortunes are quietly positioned. Right now, you're not late. You're early, but the window is closing. The crash never arrives with a countdown. It doesn't send a calendar invite or a warning bell. It comes suddenly, quietly at first, then all at once. One week, the market is hitting record highs. The next, it's unraveling faster than anyone can comprehend. And when it begins, logic evaporates. The first domino usually falls in an unexpected place. In 2008, it was the subprime mortgage market, something Wall Street dismissed as contained. In 1997, it was a tiny Asian currency crisis that spiraled into global contagion. In 2026, it could be anything. A massive corporate bankruptcy, a foreign debt default, or even a cyber attack that disrupts financial systems. But no matter where it starts, the effect will be the same. Panic. The algorithms will move first. In a market now dominated by automated trading, once a critical threshold is breached, sell orders cascade like falling dominoes. Liquidity vanishes in seconds. Prices nosedive. Circuit breakers pause trading, but confidence doesn't return. In a matter of days, what took years to build can collapse by 30%, 40%, even 50%. Then the human panic begins. Retail investors rush to withdraw, but brokers delay transfers. Banks tighten credit overnight. Margin calls force liquidation. People who thought they were diversified suddenly realize every asset is falling together. The news channels turn hysterical. Anchors speak faster. Analysts contradict each other, and the word unprecedented becomes their favorite line. Politicians rush to reassure the public. Central bankers issue emergency statements, but nothing calms the storm. Fear feeds on itself, and behind the scenes, the financial system starts freezing. When fear dominates, trust evaporates, and finance is built entirely on trust. Banks stop lending to one another. Hedge funds scramble to cover positions. Pension funds face margin calls they can't meet. Governments consider bailouts, but the problem is too big and too fast. This is the cleansing phase. Brutal, but necessary. It's when the fake wealth built on speculation gets burned away. Companies that survived only on cheap money start collapsing. Zombie corporations, those that couldn't turn a profit even with near zero interest rates, vanish overnight. Overvalued tech firms, over-leveraged real estate funds, and bloated financial institutions all begin to crumble. At first, it feels like total destruction. The media calls it the end of capitalism, just like they did in 1932, 1974, and 2008. But what's really happening is purification. The market isn't dying, it's healing. It's removing excess, clearing the rot, and preparing fertile ground for a new era of innovation and growth. To understand this process, you must look at what happens beneath the headlines. During every collapse, while the masses are liquidating in fear, a quiet minority is accumulating in silence. These are the contrarians, investors who see blood in the streets as a sign of opportunity. In 1929, when stocks had lost nearly 90% of their value, a handful of investors began buying blue-chip companies for pennies. One of them, John Templeton, famously bought $100 worth of every stock trading under $1. Most of those companies went bankrupt, but the survivors multiplied 40 times in value within a decade. In 2008, Warren Buffett invested $5 billion in Goldman Sachs when everyone else thought Wall Street was finished. A few years later, that stake paid out billions in profits. The same pattern repeated after every crash. Those who had liquidity and courage during chaos became the new financial elite in the recovery. The 2026 crash will be no different. The panic will create once-in-a-generation opportunities. Real estate prices will tumble. Tech valuations will be slashed. Entire sectors will be mispriced. The question will be, who has the discipline and foresight to act when everyone else is frozen by fear? But to capitalize, you must understand what is being cleansed. This isn't just a financial correction, it's a systemic rebalancing. For over a decade, the global economy has been addicted to cheap money. Governments borrowed endlessly. Corporations spent recklessly, and consumers lived beyond their means. The 2026 crash will force a reset. Debt will be repriced. Interest rates will normalize, meaning money will once again have real cost. This will punish speculation but reward productivity. Asset values will realign. Stocks, housing, and crypto will drop to realistic levels, creating a foundation for sustainable growth. Global trade will restructure. The dependence on fragile supply chains will break, pushing nations toward regional self-reliance. Currencies will shift. As debt crises hit, countries will experiment with digital currencies and alternative reserves to reduce dependence on the dollar. The pain will be sharp, but the recovery will be stronger because it will be based on value, not illusion. However, there's one more layer: the psychological reset. During every crash, investors learn the same lesson. Greed and fear are the two most powerful forces in finance. The crowd always moves in extremes, euphoric during booms, paralyzed during busts. But the ones who escape the cycle are those who remain rational when others lose their minds. In 2026, this will be tested like never before. Social media will amplify panic. News feeds will overflow with despair. Every influencer and pundit will scream, "Get out!" just as the best opportunities are emerging. It will feel wrong to buy. It always does. That's why so few do it. The cleansing will also expose a deeper truth, that money is never destroyed, only transferred. The same 100 trillion in global wealth won't vanish. It will simply move, from speculative hands to patient ones, from leveraged gamblers to disciplined investors. The crash will not destroy wealth. It will reassign it. And in that moment, the greatest wealth shift of our generation will occur. To most, this will look like catastrophe, but to the prepared few, it will look like destiny. They'll buy when everyone else sells. They'll acquire when others abandon. And within a few years, they'll control the assets that will lead the next economic expansion. The cleansing will hurt. It always does. Jobs will be lost. Companies will disappear. Retirement accounts will shrink. But history proves that those who keep their heads when others lose theirs will emerge not just unharmed, but transformed. Because crashes don't create winners or losers. They reveal who was prepared. So when the storm hits, remember this: markets don't reward panic, they reward patience. They don't pay for fear, they pay for foresight. This is not the end of prosperity. It's the rebirth of it, for those who see the cycle clearly. And by the time the world realizes that, it will already be too late to join the winners. After every storm, there's silence. A strange, heavy stillness that blankets everything. The dust settles. The panic fades. And for the first time in months, the world pauses to assess the wreckage. It's in this silence, not during the chaos, that the real transfer of wealth begins. Markets have crashed. Portfolios are bleeding red. Economies are contracting. Politicians scramble to restore confidence. For most people, this is the moment of retreat, the time to pull back, conserve cash, and wait it out. But history proves that this is also the moment when the next generation of millionaires starts moving quietly. Because every crash, no matter how devastating, eventually hits a floor. Fear burns itself out. Prices stop falling. The selling slows. And in that fragile, uncertain calm, opportunity is born. Look back through history and you'll see it clearly. After the Great Depression, America experienced one of the biggest wealth booms in human history. Families who bought farmland, factories, or blue-chip stocks at rock-bottom prices ended up controlling empires by the 1950s. The Dow Jones, which had fallen 89% by 1932, recovered and multiplied more than tenfold in the decades that followed. After the 2008 crisis, the pattern repeated. Real estate collapsed. Homes were selling for half their previous values. But those who stepped in, buying properties when everyone else was terrified, ended up with fortunes as the housing market rebounded. Investors who bought tech stocks like Apple, Amazon, or Tesla during that panic multiplied their wealth exponentially. This is the hidden rhythm of capitalism. Destruction creates opportunity. Every cycle clears away the weak, the over-leveraged, the overhyped, and makes space for something new, leaner, and stronger to emerge. The 2026 crash will be no exception. In fact, it might create the largest wealth transfer in modern history, not just because of the scale of the collapse, but because of the global reach of technology. For the first time ever, opportunity won't be confined to Wall Street or Silicon Valley. It will be accessible to anyone who understands timing, value, and patience. So what exactly happens during the rebirth phase? First, liquidity returns. Central banks, terrified by the depth of the crash, will pump money back into the system. Not to inflate bubbles again, but to stabilize confidence. Interest rates will likely be adjusted downward. Stimulus measures will be reintroduced. Governments will launch rebuilding programs to kickstart demand. Slowly, capital begins to flow again, but this time it won't flow where it used to. The post-2026 world will prioritize real productivity over speculation. The next wave of wealth will come from tangible value. Industries that solve real problems, not just chase hype. Energy independence. As the global energy crisis deepens, nations will invest heavily in renewables, nuclear power, and advanced battery storage. Companies leading these transformations will become the new titans of industry, AI infrastructure. Not the flashy apps or speculative crypto projects, but the physical backbone of artificial intelligence. Data centers, semiconductors, power grids, and cybersecurity. The firms building these systems will quietly dominate the next decade. Affordable housing and land development. After property prices crash, a massive demand for affordable housing will rise. Investors with capital to buy distressed assets will not just make money, they'll shape the next urban era. Healthcare and longevity. Aging populations across developed nations will spark enormous spending on medical innovation, biotechnology, and senior care. The companies solving these challenges will thrive. Defense and resource security. As geopolitical tensions continue, nations will prioritize self-sufficiency, from food production to critical minerals. Those who invest early in these strategic assets will hold immense power. In short, the post-crash world will reward builders, not gamblers. The age of easy money and meme stocks will die. The new era will belong to those who combine capital, patience, and vision. Here's where the psychology flips. During crashes, people sell what they should keep and ignore what they should buy. But the few who reverse that behavior win big. They understand that the real money is made not in the boom, but in the recovery. Because when the crowd finally feels safe again, when headlines start to turn positive and optimism returns, prices have already doubled. By the time the public re-enters the market, the smart money has already taken its positions. That's why crashes make millionaires. Not during the fall, but in the quiet, early stages of the rebound. But there's something even deeper happening in this new cycle. A geopolitical realignment of wealth. The old power centers are shifting. The U.S., while still dominant, will face stronger competition from regions investing aggressively in real production. India, Southeast Asia, and parts of the Middle East. Nations rich in energy, minerals, and manufacturing capability will emerge as the new economic hubs. This redistribution of global power will create new financial frontiers. The smartest investors won't just buy assets, they'll buy systems. They'll invest in regions, technologies, and infrastructures that define the next 20 years. And ordinary people, the ones who understand these patterns early, can ride that same wave. Because in the digital era, you don't need to be a Wall Street insider to access global opportunity. Anyone with knowledge, discipline, and foresight can position themselves before the next expansion begins.